Hey everyone, welcome back to Conviction Bets. Hope you're doing well. It has been a strange couple of weeks out there. A week ago, the tape was pricing in the end of the AI trade. On Tuesday, the Dow closed above 54,000 for the first time in its history, and the S&P 500 printed its first record close in 2 months. Same companies, same unanswered question, completely different mood. And speaking of something the market has already stopped worrying about, in the middle of all this, the market decided for a while that the most valuable company in the world should be the one mega cap that isn't spending a couple $100 billion a year building data centers. Apple took the crown from NVIDIA in mid-July for the first time in more than a year, essentially by sitting the boom out. It has since handed it back. But here's what actually matters this week. In late July, the Nasdaq fell into its second correction of the year. The Philadelphia Semiconductor Index dropped into a technical bear market. Chip stocks shed more than $1 trillion of market value. Across 49 listed AI and AI infrastructure companies worldwide, the median name was more than 40% below its all-time high, and 13 of them had lost at least half their value. 1 week later, the S&P 500 closed at a record. The market is telling a story about whether the AI bubble is finally bursting. The real story is that you were never going to get that call, right? And that call was never the thing that decides what happens to your money. I'm JL Maurer, and this is Conviction Bet. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I want to show you why the crash of 1929 does not, on its own, explain the Great Depression. The crash itself was largely absorbed within months, and a year later, the economy looked like it was about to recover. What turned a bad autumn into a lost decade was something much quieter, and it has a modern equivalent that is nowhere near the Nasdaq. And then the part I find genuinely uncomfortable, the number that decided whether someone who bought Amazon in 1999 ended up wealthy or ended up wiped out had almost nothing to do with Amazon. Let's start with the 2 weeks we just lived through, because they teach better than any forecast does. On the 28th and 29th of July, the market decided the AI build-out had gone too far. Semiconductors led the way down, the Nasdaq hit correction territory for the second time this year, and every group chat in finance was asking the same question: is this it? By the 4th of August, the S&P 500 had closed at an all-time high, and the Dow had cleared 54,000 for the first time ever. In between those two moments, not one thing was resolved. Nobody proved the capital spending will earn its return. Nobody proved it won't. Earnings came in strong, oil fell on news of talks over the Strait of Hormuz, money rotated, and the question simply stopped being asked. Now, I know the response to this because it's the response I hear every time. It goes, fine, but I'm not trying to be precise. I know it's expensive. I know it's stretched. I just want to be out before it really goes. And here's the thing about that plan. Getting out is only half the trade. You also have to decide when to get back in, and the information that finally makes re-entry feel safe is precisely the information that arrives after the price has already recovered. That's 2 calls in sequence under stress. Almost everyone who plans to do this is budgeting for one. Let me give you the cleanest illustration I know, and it comes from the crash we're about to spend the rest of this episode on. On the 5th of September, 1929, a statistician named Roger Babson stood up at the annual National Business Conference in Massachusetts and said that sooner or later a crash is coming, and it may be terrific. The news reached Wall Street by mid-afternoon, and the market fell about 3%. They named it the Babson break. 7 weeks later, he was proven right in the most spectacular way imaginable. 2 details usually get left out of that story. The first is that this was not a new call. By most accounts, he had been saying a version of it for a couple of years. If you had acted on him when he started, you would have sat out one of the great bull runs in American history and then been told you were vindicated. The second detail is worse. The business historian Robert Sobel pointed out that after the market rallied hard in the spring of 1930, Babson changed his call and told investors to buy. The Dow had climbed back to 294 that April. 2 years later, to the day, it closed at 63. The man who called the crash of the century then walked his own audience into the worst part of it, and that prediction did not make the history books. So, the investor takeaway from the last 2 weeks isn't a view on AI. It's this. If your financial plan only works when you correctly identify the top, you don't have a plan, you have a forecast wearing a plan's clothing, and forecasts have a failure rate that your mortgage does not care about. Now, let's go back to 1929 properly, because the popular version of that story is wrong in a way that matters enormously right now. Andrew Ross Sorkin published a book on it in October of 2025 called simply 1929. And it's 592 pages of people who were absolutely certain and absolutely wrong. But the numbers I want come from the Federal Reserve's own history of the event. Here's the setup. The Dow went from 63 in August of 1921 to 381 in September of 1929. Sixfold in 8 years. And a whole new industry of brokerage houses and investment trusts had been built to let ordinary people participate. Typically, you put down 10%, you borrow the other 90%. The shares you bought served as the collateral for the loan, which means a 10% decline in the price wiped out the entire equity of the person who bought it. And the people closest to it were the most confident of all. In October, Charles Mitchell, president of National City Bank, which is Citibank today, and at the same time, a director of the Federal Reserve Bank of New York, organized a group of bankers to publicly buy large blocks of shares at high prices to restore confidence. It failed within days. Around the same time, Irving Fisher, the most celebrated economist in America, told an audience that share prices had reached what he called a permanently high plateau. These were the best informed men alive on this subject. They had the most data, the most access, and the most at stake. They were also the most wrong. Then it broke. On Black Monday, the 28th of October, the Dow fell nearly 13%. The next day, nearly 12%. By the middle of November, it had lost close to half its value. And now here's the part almost nobody knows. The Federal Reserve Bank of New York did roughly the right thing. It bought government securities, it lowered its discount rate, it told the commercial banks it would supply whatever reserves they needed, and then it did. The stock market collapsed, and the banks at the center of the storm stayed open. That didn't make it painless. People had lost their savings, they were frightened about their jobs, and they stopped buying the expensive things people bought on credit, automobiles above all. Ford saw the demand fall, slowed production, and furloughed workers. That's the second channel, and it runs on confidence rather than credit. But it washed through. The Fed's own account of this period says that the damage from the crash faded within a few months, and that by the autumn of 1930, economic recovery appeared imminent. A year after the greatest crash in the history of Wall Street, the American economy looked like it was about to be fine. What happened next is the actual subject of this episode. Starting in November of 1930, the banking system began to fail in waves. More than 9,000 banks suspended operations between 1930 and 1933, around 30% of all the banks that existed at the end of 1929. And when a bank fails, it doesn't just take deposits with it, it stops rolling over the loan on the factory. It stops extending credit to the farm, the shop, the builder. A business that was solvent and well-run on Monday cannot make payroll on Friday because the entity that funded its working capital no longer exists. That is how a market event reaches a person who never owned a share of anything. The Dow bottomed on the 8th of July, 1932 at just over 41, 89% below the peak. It did not get back to its 1929 high until the 23rd of November, 1954, 25 years. So here's the way I want you to hold this, and it's the image I'll come back to at the end. A crash is a fire in one room of the building. Whether it burns down the building depends entirely on what connects the rooms, the shared walls, the wiring, the ventilation. By late 1930, the banking system had become the connective tissue, and there were no fire breaks in it, no deposit insurance. And once the panics went nationwide, no sustained lender of last resort response. The New York playbook from October 29 was never scaled up to meet what came after. Nothing to stop a loss in a brokerage account from becoming a closed factory in Ohio. We built those fire breaks afterward. Federal Deposit Insurance came in 1933, and it is genuinely one of the great pieces of financial engineering in history. So the investor implication is not watch out, stocks are high. The price you pay matters enormously, and we'll get to that. But price alone won't tell you how far the damage can travel. For that, you have to watch the credit system, whether it's absorbing the losses or passing them along. Which brings us to where the wiring runs today. Because the AI build-out has quietly changed its funding source, and almost nobody talks about it. In the early phase, this was the most conservatively financed boom imaginable. A handful of the most profitable companies in history spending their own operating cash. That's not a credit event. If Microsoft spends its own money on something that doesn't pay off, Microsoft has a bad few years. That doesn't automatically become a system-wide credit event. That's not what's happening now. JP Morgan puts total AI-related spending on track for roughly $870 billion by the end of this year, up about 77% from the year before, with the hyperscalers accounting for around $750 billion of it. Microsoft now guides to about $175 billion of reported calendar year capital spending, down from $190, and that $15 billion drop is not a cut. Microsoft extended the assumed useful life of its data centers from 15 years to 25, which pushes more of its future leases out of the finance lease bucket and into the operating lease bucket. And finance leases count in reported CapEx, while operating leases don't. Amy Hood said it plainly on the call. Outside that accounting effect, the calendar year investment expectation is unchanged. The spending didn't shrink. It moved off the line. Investors were watching. Alphabet raised its outlook to about $205 billion. Amazon raised its number to $220 billion, up $20 billion from where it stood in April because memory got more expensive. Meta, $130 to $145. Not every dollar of that is AI. Amazon's figure also covers robotics and satellites. But the direction isn't ambiguous, and the build is consuming a far larger share of the cash these businesses actually generate. Here's the number that captures it. JP Morgan Asset Management puts hyperscaler AI capital spending at 93% of their cash flow from operations this year, up from 33% in 2023. Almost every dollar these companies produce by running their businesses is going straight back into the ground. You can see it in the individual reports. Amazon's free cash flow over the last 12 months swung to an outflow of $7.6 billion from an $18.2 billion inflow a year earlier, which the company attributes principally to a $66 billion increase in spending on property and equipment. Microsoft's free cash flow fell 23% in the June quarter. Now, that on its own doesn't prove they're borrowing to cover the gap. They could run down cash, sell investments, trim buybacks, sign leases. But when an analyst asked Andy Jassy how Amazon intends to fund the rest of it, he said there was nothing to share today. Here's what that looks like in practice. And I want to keep these figures apart because they measure different things. The hyperscalers issued roughly $121 billion of bonds in 2025, more than 4 times their 5-year average. That is 1 year of issuance by a handful of companies. Separately, JP Morgan analysts estimate about $1.2 trillion of debt outstanding across a much wider universe of AI-related businesses. That's a stock, not a flow. You can't add the two together. Then there is private credit. The Bank for International Settlements calculates that outstanding private credit loans to AI-related companies have gone from almost nothing to more than $200 billion, close to 8% of all private credit lending. And Morgan Stanley has done the arithmetic on where the rest of it comes from. Roughly $2.9 trillion of global data center investment through 2028, of which big tech's own cash flow is expected to cover about $1.4 trillion. That leaves a financing gap of about $1.5 trillion, and Morgan Stanley expects the single largest share of it, around $800 billion, to come from private credit. The template closed in October of 2025 when Meta and Blue Owl financed the Hyperion campus in Louisiana about $27 billion of debt inside a package of roughly $30 billion, the largest private credit transaction of its kind ever done. The debt sits in a separate vehicle rather than on Meta's balance sheet. But Meta is the developer, the operator, and the tenant. The accounting moved. Meta's economic exposure didn't. And here is the sentence I'd underline on Mackay Shields' numbers. Through the end of June, AI data center and power issuance accounted for 45% of net high-yield issuance in the U.S. this year. Net meaning after maturities and repayments. Nearly half of all the new junk-rated paper the market absorbed in a single theme. Now, is the wiring hot? The honest answer is that the smoke detector is beeping and the building is not on fire. Look at the demand side of those bond deals. Torsten Slok, the chief economist at Apollo, tracks what the bond market calls the cover ratio. How many dollars of investor orders come in for every dollar of bonds on offer? In February, hyperscaler deals were covered nearly 5 times over. By July, that had fallen below 2. For investment-grade bonds as a whole over the same stretch, the same measure slipped by about half a point. Slok's own reading is careful. It suggests investors may need wider spreads to absorb this much supply. That is not the bond market calling the top. Bigger deals and heavier issuance can push that ratio down on their own. But it does mean the cost of funding this build is being set by a tougher audience than it was 6 months ago. Through July, credit spreads on Alphabet, Amazon, and Meta widened. In Oracle's 5-year credit default swap, the market's chosen proxy for AI debt anxiety, was trading at a multi-year high. Meanwhile, the equity market printed a record on Tuesday. That divergence is the story. The stock market is voting on the narrative. The credit market is quietly repricing the funding. And credit conditions are usually what decide whether a fall in asset prices stays contained or turns into something broader. So what would I actually watch? Not the Nasdaq. I'd watch that oversubscription ratio. I'd watch whether AI-linked issuance keeps clearing at reasonable spreads. And I'd watch whether the banks arranging this paper keep successfully selling it on into the bond market or start having to hold it themselves. That is the modern version of the 1930 question. If financing conditions deteriorate, it will often show up in spreads and deal execution before it's obvious in the share price, though I would never promise you that sequence. But that's only half the story. Because the honest version of this analysis has to include the part where the fire breaks are working. The Federal Reserve Bank of Chicago published a study earlier this year looking at exactly this. Their estimate: the average bank's outstanding exposure to AI-adjacent industries is around 0.8% of total assets. Delinquency rates on that lending are in line with the rest of the loan book. In late 2025, large banks' commercial and industrial commitments to these borrowers ran around $450 billion, with only about $150 billion of that actually drawn. Set that against roughly $1.2 trillion of AI-related debt outstanding, and direct exposure on regulated bank balance sheets looks modest. That is a meaningful structural difference from the early 1930s. It is not the same as saying banks are absent from the chain. They still arrange this paper, extend the credit lines, and lend to the funds that hold it. That is a real, meaningful difference from 1929, and it deserves to be said plainly. One of the central mechanisms that turned that downturn into a depression, a fragile banking system with no deposit insurance and no consistent nationwide backstop, is not present in the same form today. 2 things I'd add, though. The Chicago Fed's own paper flags the tail risk. Stress in one AI-adjacent industry can spill into several interconnected ones at once because the software companies, the chip makers, the power providers, and the data center developers are all leaning on the same assumption. And the second thing, carefully, the risk hasn't disappeared. It's moved. It's sitting in private credit funds, in separately incorporated entities, in lease structures. That structure is far less likely to produce a classic run on deposits than the banking system of 1930. Whether it's safer overall, I don't know, and I'd be suspicious of anyone who says they do, because the leverage and the counterparties are harder to see from out here. Let's bring this back to what it means for an investor. The real economy exposure here is narrower than 1929, but it isn't small. Bridgewater estimates AI capital spending is contributing around 140 basis points to U.S. growth this year, comparable to the contribution business investment made during the tech bubble. Epoch AI's data puts computing infrastructure at roughly 1.5% of GDP against an average of about 0.7% in the years before this started. So, a sharp slowdown in AI construction would be a real headwind to business investment and near-term growth, not a clean subtraction, but not a rounding error either. But there's a wrinkle that cuts both ways, and JP Morgan Asset Management has been making the point for a while. A Finnish data center employs very few people. This boom put a lot less money into household paychecks than a factory boom would have, which means that if the build-out slows sharply, the channel into household income is thinner than it was in 1930. But there is a channel 1930 did not have, and Citi Research flagged it in July. American consumer spending has been running ahead of income growth, propped up by the run-up in stock prices, with the savings rate down at historically low levels. Citi's point is that a significant fall in equities would push saving up and spending down on its own. The wealth effect that made this boom feel good on the way up is a transmission channel on the way down, and it does not require a single bank to fail. So the takeaway is narrower than I would like. My read is that this cycle is more likely to reach you through your portfolio than through your employer, but the portfolio channel is not as private as it sounds. Your portfolio is still the part you control. So let's talk about that. Let's talk about the leverage in your own account. In June, FINRA reported margin debt in the United States at an all-time high of $1.53 trillion, up 51.5% in 12 months. Customer credit balances, netted against what those customers owe their brokers, hit a record low of negative $1.06 trillion. And on Advisor Perspective's analysis of that same FINRA series, adjusted for inflation, margin debt has grown 604% since 1997, while the market itself grew 354%. On that measure, the gap is the widest in the history of the series. And that's just the borrowing people did on purpose. As of February, Morningstar counted 355 leveraged single-stock exchange-traded funds listed in the United States. All but 80 of them had launched since January of the previous year, and more have arrived since. Take the wider universe. Every leveraged exchange-traded product, not just the single-stock ones, and industry assets have moved past $190 billion. Brian Armour, who covers this space at Morningstar, put it about as bluntly as an analyst can. The sheer number of launches shows how much the market has come to depend on speculation. These are designed as short horizon trading instruments, not as buy and hold investments. They reset every day, which means the path matters as much as the destination. A volatile route can leave you a long way from simply multiplying the stock's move. And the audience is overwhelmingly retail. A study co-authored by Direction, one of the issuers, with Vanda Research found that nearly 90% of all trading in leveraged single stock funds traces back to individual investors. And it isn't only the borrowing that has changed. What people are borrowing against is more concentrated than it has ever been. On RBC Wealth Management's numbers, the top 10 stocks were about 23% of the S&P 500 at the end of 2000. The peak of the last technology bubble, about 19% at the end of 2015, and a record close to 41% last year. A cap-weighted index now puts far more of your money into a small group of megacaps, most of them, though not all, exposed to the same cloud and AI spending cycle. Your index fund is a narrower bet than it was at the top of the dot-com boom. And the monetary backdrop is nothing like the one these historical comparisons come from. The Federal Reserve's balance sheet stands near $6.7 trillion against roughly $900 billion before 2008, and it is about $95 billion larger than it was a year ago. Quantitative tightening has ended. That is not a new round of easing, and I won't claim it is. But it does mean the system these bubbles are forming inside is structurally different from the pre-crisis one. Now, why does any of this matter more than the valuation debates? Because of what leverage does to the arithmetic of being right. Take one of the best long-term business calls anyone could have made in the last technology bubble. If you had looked at Amazon in 1999 and concluded correctly that this was one of the most important companies of the coming century, you would have been more right than almost every professional investor alive. And then the stock fell about 95% between its high in late 1999 and its low in late 2001. It did not reclaim that high until late 2009, a decade later. And by one analysis from Ensemble Capital, it took until 2014 before someone who bought in 1999 had earned 10% a year on the money. 15 years of waiting to earn a normal return on the greatest business call of the era. The index tells the same story. The Nasdaq peaked in March of 2000, fell 78%, and took until April of 2015 to make a new high. If you owned Amazon without leverage and you didn't need the money, you kept the only thing that mattered, the option to wait. If you owned it with borrowed money, the market took that option away from you before your thesis had time to be proved right. Your broker closed the position somewhere on the way down, and the fact that you were correct became a piece of trivia. This is what Buffett was getting at in his 2010 letter to shareholders. When he wrote that leverage, and I'll quote him exactly here, all too often produces zeros. His argument was that any string of good returns, however impressive, evaporates the moment it's multiplied by a single zero. 7 years later, he made it personal. In the 2017 letter, he printed a table of Berkshire's own worst drawdowns, 4 occasions on which its shares fell more than 37%, the most recent of them, a fall of roughly half between September of 2008 and March of 2009. He called that table the strongest argument he could muster against ever using borrowed money to own stocks. Even an exceptional long-term holding like Berkshire would have destroyed a leveraged owner 4 times over. So the so what here is very concrete. The number that determines your outcome is not your estimate of fair value. It's the size of the decline you can hold through without being forced to act by a margin clerk, by a job loss, by a tuition bill. That number is set by your borrowings and your time horizon, and it is set before the drawdown starts, not during it. And I know what the strongest case against everything I've just said is. It goes like this. This is nothing like 2000s and nothing like 1929 because the revenue is real. Microsoft's Azure grew 43% last quarter, and its book of contracted commercial revenue signed but not yet delivered jumped 84% to $678 billion. Alphabet's Google Cloud grew 82%. NVIDIA's data center revenue grew 92% in its most recent reported quarter to $75 billion. Amazon's AI and semiconductor businesses inside AWS each passed a $25 billion annualized run rate. Third quarter memory contracts are settling 20 to 30% higher, not lower. Google and Meta have locked in 5-year supply agreements. Analysts don't expect meaningful new supply until 2028. These are not companies burning venture money on Super Bowl ads, and every year you spend being careful about this is a year of returns you hand to someone braver. And look, that's largely correct, and the concession is real. I'd add one more against myself. The popular claim that index funds are inflating, this whole thing doesn't hold up well either. Index funds and ETFs did pass active funds in total assets 19 trillion versus 17 trillion as of March. But Bloomberg Intelligence's work last year put passive vehicles at roughly 13% of the actual US stock markets, a bit over 20% of the S&P 500, and found no meaningful evidence they were distorting prices. If you were hoping I'd tell you the ETFs are the villain here, I can't, because the data doesn't support it. But here's why the thesis survives all of it. Amazon's revenue was real too. It grew more than 140% between 1999 and 2002. The stock lost about 95% of its value in the middle of that stretch. The business being real has never been the question. The question is what price you paid for it and whose money you paid with. Those are 2 different questions, and a bull market makes them feel like the same one. And notice what the strong bull case actually concedes. Every number in it describes demand. Not one of them describes the funding. The funding is the part that has quietly shifted from corporate cash flow to bond markets and private credit in the space of about 18 months. And funding is where the crash of 1929 became the catastrophe of the early 1930s. So let me land this where it belongs, which is your account, not the Nasdaq. Put the pieces next to each other. A record amount of margin debt sitting in customer brokerage accounts, an index more concentrated than it was at the last peak, nearly half of net high yield supply funding a single theme, and a bond market that has quietly started asking to be paid more for funding it. I am not telling you the fire is coming. I'm telling you the building is more connected than it looks, and that the connections are in places that don't show up on the screen you check every morning. You do not get to choose whether it burns. You get to choose in advance how far it can travel into your life. That's the fire break. It is not a forecast, it's a structure. How much you've borrowed, how soon you need the money, and how much of your future is riding on one theme being right on schedule. Build it while the market is at a record high, because that is the only time anyone will let you. And practically, a fire break is 3 questions, none of which require you to have a view on AI at all. First, if this position fell by half and stayed there for 5 years, does anything in my life actually break? Not would I be upset. Would something break? Second, is any of this borrowed, including the borrowing I don't file under borrowing, the leverage fund, the margin balance I took out when rates were low and never unwound? Third, when do I genuinely need this money? Because the person who bought Amazon in 1999 eventually did fine. The person who bought Amazon in 1999 and needed the money in 2003 did not. Pause. Plenty of the people ruined in 1929 and in 2000 had a view on the markets and a good one. What separated them from the survivors wasn't the quality of the view. It was whether being wrong for a while was survivable. Anyway, that's this week. If you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.